welcome to Know Your Company, that is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single listed company every day. So today's company that we're talking about is Samhi Hotels. What happens with this one is going to be interesting because clearly if you talk about Samhi Hotels, the key question that we ask over here is it slowing or growing? Now, to get you more details in terms of the company, firstly, a prominent branded hotel ownership and asset management platform in India. They've raised nearly almost 1,300 to 1,400 odd crores through its maiden IPO, and the company was listed in September 2023. Now, 8 hotel operator brands is what they have. And if you talk about the operator brands, you have Courtyard by Marriott, Sheraton, Hyatt Regency, Hyatt Place, Fairfield by Marriott, 4 Points by Sheraton, Renaissance, as well as Holiday Inn Express. Overall, if you talk about the total number of hotels, it's a portfolio of almost 28 of them. And in terms of their portfolio, the breakdown is between upper scale and upscale, which is around 30% of their portfolio. Upper mid-scale is around 40%, and the remainder is mid-scale, which is around 30. So that breakup between the three is in that range of around 30 to 40% as we speak. Overall, they have almost around 1,682 keys, and these are 8 hotels in that upper upscale and in the upscale portfolio. If you talk about the upper middle scale, which is 15 hotels, they have around 2,250 keys. And if you talk about the mid scale, they have 12 hotels with nearly 1,730 keys. So that's the numbers that we are working around with. So clearly, the highest one in terms of number of keys is in the upper mid-scale segment of the company. But now let's understand what are the rating parameters that we are using this time around with regards to where Samhi Hotels goes. Firstly, we will talk about the income statement. Mahima will shed some more light on that one. Along with that, we'll talk about the balance sheet, how strong it is or not. The cash flows are very crucial over here, taking into consideration the expansion plans that Samhi Hotels has from here on. And the profitability number is key. You talk about the shareholding, where to understand it's a mainly FI, DII driven company, so there are no specific promoters that are running a Samhi Hotels. But what's happening with the FI and DIIs is going to be crucial. The street credentials, valuations. Now, valuations over here will not give you a P, but we'll give you an EV by EBITDA, taking into consideration a few of the parameters. You're talking about the street coverage, as well as the outlook that the analysts hold on this one. So these are the parameters that we will be rating Samhi Hotels with. But first up, let's look at the income statement. Let me also get in Mahima to get us more details. Mahima, welcome. And firstly, the income statement, if you talk about the top line, the margins and the profitability, what is it telling you?
Right. It's painting a good picture, definitely, in terms of the total income for Samhi Hotels. The 3-year CAGR has been around 76%. 9 months FY25, the numbers stood at around 826 crore, which was around 979 crores in FY24. For EBITDA, the overall 3-year CAGR has been around 166%. So good growth there as well. 9 months FY25 numbers stood at 313 crore. Margins have improved from 29.4% in FY24. This is consolidated margins to 36.2% in 9 months FY25. And net profit. So the company has become profitable now in 9 months FY25. FY24, there was a loss of around 235 crore, which is now been a profit of around 39 odd crores in 9 months FY25. In terms of operational metrics also, the overall RevPAR, which is revenue per available room, has been on an upward trend. If we see the quarter-wise performance, the RevPAR in Q3 had a growth of around 15% YOY, before that it was 16% YOY, and so on. So the RevPAR overall has always shown a double-digit growth in the past few quarters. In terms of other operational metrics, where overall operating rooms stand at around 4,939, the occupancy overall in 9 months FY25 stood at 74%. The average room rate in 9 months FY25 was 6047. That is 6,047. And in terms of their portfolio divided into domestic versus international, the overall portfolio, the domestic mix stands at around 79% versus that of 21% in international. And the upper and upscale hotels The ratio is around 66% in domestic and 34% in international. In terms of segmental performance, like Hiral mentioned earlier, there are three different segments in which the hotels operate. The first one is upper upscale segment, where the occupancy is stable, the average room rate and RevPAR are on an increasing trend. 43% of asset revenue for Q3 FY25 came from the upper upscale segment, and 34% of this revenue came from food and beverages. In terms of upper mid scale, the occupancy is stable. Again, ARR and the RevPAR are on an increasing trend. 42% of asset revenues for Q3 came from this segment, and 25% of that came from food and beverages. Now, lastly, mid-scale assets. In this, occupancy as well as average room rate and the RevPAR are on an increasing trend. 15% of total asset revenues in Q3 FY25 came from mid-scale, and around 8% revenue came in from food and beverages. So here there has been a slowdown in terms of revenue from food and beverages, which is also overall has had an impact on the Q3 numbers. Lastly, in terms of segment-wise, the RevPAR, the upper upscale has seen a growth of around 16%, and the revenue mix is around 43%. The mid-scale has shown a growth of 18%, and the mix is around 43%, the revenue mix. And mid-scale has shown a growth of 10%, and the revenue mix is at 14%. So overall, good operational metrics as well as good performance where the four key numbers are concerned, that is your revenue, EBITDA, margins and net profit, and which is why we've given a thumbs up for this particular counter.
Absolutely, a thumbs up is what is warranted here, because clearly from what Mahima is pointing out to as well, the story seems to be growing so far, at least in terms of the first parameter. But let's move on to the balance sheet. Now, what's interesting over here is if you look at the net worth, the gross debt and the cash and bank. In terms of the net worth, that's almost equivalent to the gross debt of the company, and that is the concerning area, because if you talk about the FY24 debt, 1,560 odd crores is what the company was sitting on, with a net worth of around 139 and a cash and bank balance of around 150 odd crores. Whereas if you talk about the first half of FY25, the gross debt has increased, and this is to the tune of nearly almost 100 odd crores to 1,650 odd crores, and their net worth has grown marginally. The cash and bank has also remained pretty much stable, a 150 to a 195, so not a major improvement on that front. But the gross debt, if that keeps increasing from here on with the kind of expansion plans that the hotel is sitting on, that could be a concerning point, and that's something we will speak to the management as well shortly as to how do they plan to manage this aspect. So clearly, with the net worth, the cash and bank balance that they have, it's a neutral rating coming in on that front, Mahima.
Absolutely. In terms of the cash flow as well, overall, if we see the cash flow from operations, they've been around of the same range. Overall cash flow from operations in FY24 stood at 157 crores, which is right now 122 crores. But the real picture will come when the year ends, and we'll have to compare the FY25 numbers with FY24 numbers. But in terms of the net cash flow position, the net cash flow position for first half of FY25 stood at 62 crores, which was 500 crores in first half of FY24. And this is because net cash flow was significantly higher because of the IPO proceeds that they had received. So this, is not a like-for-like comparison, because this also includes the overall amount which was, received from the IPO proceeds. So overall picture of cash flow, although in positive and in good numbers, which is why we've given a thumbs up where cash flow is concerned.
Right. So two parameters or three parameters that we've spoken about so far, but now let's understand the shareholding pattern, because why that is important is because this is a company which is mainly held strongly by FIs, DIIs and the public. There is no promoter that is involved in a way with Samhi Hotels. Now, what's happening is the FI holding has been on a reducing trend. From a 64.6% in September 23, it's actually gone down to 54.8%. Similarly, the DIIs are also offloading. It's gone down from 22.4% to a 18.6%. Yes, one aspect we need to consider is with regards to the absolute number of shares, but overall it's a declining trend there. And the public shareholding has doubled or more than doubled from a 12.9 to a 26.7. So there are concerns coming in that why are FIs and DIIs offloading, and what happens with regards to retailers, because mutual funds are now holding 15% stake. You have your AIFs, which are holding around 3.5%. Your FDI is around 22.9. FPI is around 31.8. Individual holding stands at around 20.3. You have Madhuri Madhusudan Kela is holding 1.7, and corporates are holding around 3.4%. So yes, Madhuri Madhusudan Kela coming in is something which the street is looking forward to. But the key trend with FIs and DIIs offloading, that's one of the reasons why to this one, if you talk about the rating as well, it's a pretty mixed rating that comes in over here, and we give it a thumbs down though, mainly because FIs and DIIs are offloading.
Right, absolutely. In terms of the street cred also, Hiral, overall, it did list at a premium of 7%. It listed at around a price of 134. The overall stock price has been up around 12% since its listing now. The stock has been up 20% as compared to its issue price, which stood at around 126. And the stock is down by about 28% in the past 6 months overall. But of course, this is on the back of the market weakness that is also taken place in the past 6 months. But overall, since the stock has been down 28% in the past 6 months, but it's still 12% above its listing price. We've given it a neutral rating for now, and we'll have to wait and watch out for as to how overall their capex plan plans out, how key additions take place, and how occupancy rate also goes up from now, and how that adds to the overall top line. And that is something which will also make even investors interested in the stock, and then see how the stock performance pans out.
Right, and the next one is with regards to valuations. What is interesting is between Samhi, Chalet, Indian Hotels, ITC, EIH and Lemon Tree. These are the ones which we've compared. And if you talk about the valuations, the current trailing for Samhi is not something that we're looking at. We've given a EV to EBITDA trailing which stands at around 15.5 times. If you talk about the other companies as well, clearly, this is one of the cheaper ones in terms of Samhi. Chalet is on the expensive side. Indian Hotels, of course, is on the expensive side. What comes in line with them is somewhere like a EIH. Lemon Tree, again, on the expensive side, right? So it's a neutral rating. It stands in between. We will have to watch out for the price to earnings, taking into consideration that it's just turned profitable. So from here on, the way the valuations pick up with the performance is going to be key. So we will watch out for the future valuations from here on, but slightly on the neutral side, only and only reason being that the company has just turned profitable now, and it's still in between all of the names that we've already mentioned so far.
Right, absolutely. And in terms of the analyst recommendations, there are overall 5 brokerages that are covering the stock at present, and all 5 have given a buy rating. And the overall return potential as per Bloomberg consensus stands at around 91%, which is why we've given a thumbs up. So overall, in terms of street coverage and analyst recommendation, all buys, no hold and no sell, and overall a 91% return potential, which is why we've given a thumbs up for the counter.
So 91% return potential and a thumbs up. But let's overall look at the outlook from here on. They're expecting a RevPAR growth to be stronger in the coming quarters, and a 18% inventory addition to 5,650 rooms, and the net debt of around 1,700 to 1,800 odd crores in 2 to 3 years. So that is something which the company seems is not worried about. That's the range, and we are way below the range right now. In terms of upper upscale, they're planning to double the inventory in this portfolio, and addition rooms will come in the existing hotels. They're looking at conversion of 4 points by Sheraton, Pune and Jaipur, and the existing building in High Tech City. They're opening up of Westin Bangalore, Whitefield as well. You're talking about upper mid-scale, they're looking at addition of inventory at Fairfield by Marriott at Chennai. And in terms of mid-scale, they're growing Holiday Inn Express portfolio and openings in Greater Noida as well. So that's with regards to the overall outlook that the company has given and in terms of the guidance. But let's quickly look at the rating performance. If you talk about the final rating performance, it's a 5.5 on 8, where income statement is a up, cash flow is a positive, shareholding is a downer, balance sheet is a neutral. So these are the 4. And street coverage outlook, again a positive, valuations and street credentials, a neutral. So taking all of this into consideration, it's a 5.5 on 8. But the caveat being over here, that when you're looking at the kind of guidance that the company has, the kind of capex that they're looking at in terms of expansion, how that will turn around into a higher rating from here on. In fact, now let's welcome in Ashish Jakhanwala, Chairman and Managing Director and CEO at Samhi Hotels. Ashish, good morning and welcome to the show. I mean, I'm sure you've heard the entire conversation we've had, and we've actually dissected Samhi so far. But let's start with your overall outlook in terms of the growth that you're looking at from here on, in terms of your top line and bottom line, because that's an aspect which has been absolutely strong.
So thank you for having us on the show. So when you talk about growth, it's important that we split it into two buckets. One is same store, and the other is growth coming because of renovation, rebranding, and inventory addition. We've always stated that I think given the fact that most of our inventory is in tier one office locations, we expect the total revenue growth to remain high single digits to early double digit. So that's only for the stable hotels. If we add to that the impact of the rebranding, renovations, and inventory addition, we do expect to maintain, I would say, mid to high teens total revenue growth over the next 3 to 4 years.
For your revenue per available room, Ashish, Mahima also joining in, you know, the entire trend has been that it has grown in double digits. Going forward, how do you expect that trend to pan out? Do you expect, because right now in Q3 it was a growth of around 15% YOY, but it has been 20% before as well. So do you think that, you know, percentage of growth will increase? And then how do you expect your top line to pan out, let's say by the end of FY27 from a longer term perspective?
So I think, as you know, total revenue in hotels, comprises of two parts, RevPAR and what comes from other sources like food and beverage. So if you talk just RevPAR, which is largely room revenue, we remain fairly upbeat. We think that the company should be able to maintain a double-digit RevPAR growth on same set of hotels. I think it's really important to clarify that in several portfolios, when you see the RevPAR growth, it's not same store, and there are additions and deletions in the portfolio. So for the same store assets, we think we'll maintain a double-digit RevPAR growth. I would say about 13 to 14%. Total revenue growth, as I will repeat, that for the same set of hotels, we expect it to be around, as I said, high single digits to early double digits, because we have seen that the room revenue growth is higher than what we see from other sources. So there is some bit of a diminishing impact of food and beverage and other sources on total revenue. So that's how I split the total revenue growth in the portfolio.
Right. So, okay. So from here on, if you have to talk about whether the company will remain in the black, what's the trajectory looking like? Because you have turned profitable. You think this is something that will continue, taking into consideration your expansion plans that you have?
Yes, absolutely. I think one area where we have no doubts about is the fact that the turn to profitability is consistent, it's sustainable, quarter on quarter and through the years. So there is absolutely no doubts in our mind about remaining a profitable company in future. In terms of growth, it's important to note that all of our growth is funded from internal accruals and internal cash flows. So we don't see the gross debt really increasing in the portfolio. So what's really happening is that the free cash the company is getting, it's deploying that for creating growth for itself. And because all of our growth is really quick, I would say CapEx to revenue conversion, you would see the impact of that coming down to the bottom line. So you will see both net debt to EBITDA number and the profitability number improve year on year. That's something that we are fairly certain about.
Ashish, in terms of the FIs and DIs holding, we've seen that they have been offloading stake. You must be having conversations with your investors. What are the conversations looking like, and why do you think that they're offloading?
So first of all, I think a part of the FII stake reduction is on account of the sale by some of our pre-IPO investors that happened last year. I wouldn't really classify that as FII sellings. These are investors who were in the company for the last 10, 12 years, and they had a lock-in for 6 months, which expired last year. So FII reduction from 64.6 to 54.8 was largely on account of some of the pre-IPO investors exiting. We haven't really seen any concerning trend with respect to our public holders really selling the stock. So that's my view on the FII. And honestly, quarter on quarter, investors are revaluing their portfolios. But some of the big investors that we have in our portfolio, we continue to have conversations with them. We don't see any trends which are concerning to us.
So Ashish, my question to you will be, are you looking at any other marquee names to come in, taking into consideration some portion of lock-in also ends, in recent days now?
So let me clarify. The lock-in, what is expiring, the number may be large, let's say about 20 odd percent. But the fact is, one of the largest shareholders in the company has been Asia Capital or ACIC, and they've not really sold a single share for the last year and a half. So while technically the lock-in is expiring, I really don't expect that block to come into the market. So we really don't see a lot of supply coming in. In terms of bringing in market investors, I have built the company with institutional investors over the last 14 years. That's been a strength. And therefore, we continue to look at some good investors who can join the cap table, and we can build the company alongside them.
Ashish, you've overall guided that you'll be adding, over 18% of inventory, and this will lead to addition of 2650 odd rooms. What will the capex number roughly? Overall, you've also said that your net debt will remain within that range of 1700 to 1800 odd crores in 2 to 3 years. But after 3 years, do you think that this debt will then see a decreasing trend?
I think the debt will. So we got to a peak debt as of December 2024, and that's largely on account of the acquisitions we made in Hyderabad and Bangalore. So the reason you saw a slight increase in the gross debt was because of those two acquisitions. From Q4 onwards, we've seen free cash coming into the business, which will eventually reduce our net debt. So I think pretty much we've seen the peak debt scenario as of December 2024. In terms of debt reduction, there are really two sources for that. One is, of course, the free cash that we're getting year on year. And I'll just take you through the capex requirement. And the second is the fact that we have announced what we call a capital recycling program, where we have sold some of our small hotels where the contribution to earnings was insignificant. And that capital also goes towards further sort of improving the overall balance sheet. So we've sold one hotel in the last month and a half or so in Chennai. We have a plan to continue with asset recycling. So when you look at free cash from the business and the proceeds from asset recycling, we feel fairly confident that we'll be able to take the net debt to EBITDA below 3.5 times over the next 12 to 15 months. In terms of capital expenditure, we have a planned capital expenditure of about 700-800 crores. And therefore, on an annualized basis, we'll see about 150 to 180 crores of capital expenditure over the next 4 years, all funded from internal accruals.
Okay, so all funded from internal accruals is what you're looking at. And I think that is key because if the debt remains the same with the capex plans that you have, I think the story is going to be whether Samhi Hotels warrants a re-rating by analysts or not. But thank you, Ashish, so much for joining us on the show and sharing your views. So that's the management of Samhi Hotels. And overall, the key question from here on is, Mahima, that with the plans that the management is giving us and with the analysis that we've done, from a 5.5, whether with the performance over the next few quarters, will the company be able to get a higher rating, and whether there will be a re-rating that could be happening by analysts on this counter or not. So Samhi Hotels, another KYC candidate for another 3 to 4 quarters. But completely out of time. With this, it's a wrap on this edition of Know Your Company. Please stay tuned for more on NDTV Profit.